If I told you that some of the best investments in the world are completely boring? No flashy tech, no hype, no revolutionary innovation. Just boring. You might think, how is that exciting? But Warren Buffett, arguably the greatest investor of all time, loves boring businesses. And today, we're breaking down exactly why. Welcome back to Money Mastery Insights, where we make smart money moves simple. Let's dive in. 1. Boring businesses are predictable. Buffett famously said he likes businesses that even an idiot could run. Not because he wants idiots running them, but because the business model is so simple that it's hard to mess up. Think about companies like Coca-Cola, See's Candies, or BNSF Railway. Not exactly the stuff of Silicon Valley thrillers, but you know what they offer? Consistency. People drank Coke 50 years ago. They drink it today, and they'll drink it 50 years from now. That predictability makes it easier to forecast profits and easier to sleep at night. 2. Boring businesses have moats. A moat is just a fancy investing term for what protects this business from competitors. Boring companies often have surprisingly strong moats. Brand loyalty, Coke scale advantages. Walmart, high switching costs, insurance companies, regulated positions, utilities. These moats keep competitors out and profits steady. Buffett doesn't chase excitement. He chases durability. 3. Slow and steady can compound like crazy. A business that grows earnings by 8% every year might not sound impressive, but over 20 years, that's powerful compounding. Buffett loves this. Because if he can buy a great business at a fair price and sit on it for decades, the math works out beautifully. Here's a simple example. If you invest $10,000 in a company that grows at 8% a year, in 20 years, it becomes over $46,000. No drama, no hype, just math. 4. Boring businesses are often underpriced. Because these companies aren't exciting, they often don't get the attention or the inflated prices that trendy tech stocks do. Investors chasing the next big thing overlook the quiet giants right in front of them. Buffett loves buying dollars for 70 cents, and boring businesses often give him that chance. 5. Boring businesses perform well in good and bad times. When the economy is booming, people buy Coke. When the economy crashes, people still buy Coke. The same is true for insurance, railroads, utilities, and consumer staples. These businesses tend to weather storms better than more volatile industries. This stability helps Berkshire Hathaway, Buffett's company, grow steadily over the long term. 6. They generate tons of cash. One thing Buffett loves: cash flow. Boring businesses often require less reinvestment because they're already proven systems. That leaves more cash to pay dividends, buy back shares, make acquisitions, or simply pile up on the balance sheet waiting for the next opportunity. Buffett calls this float when he is talking about insurance, and it's one of his secret weapons. 7. You can understand them. Buffett avoids businesses he doesn't understand, not because he's old-fashioned, but because unclear businesses carry hidden risks. Ask yourself, would you rather bet your money on a biotech startup with no revenue, or a company that has sold the same product successfully for 100 years? One is exciting. One is predictable. Buffett consistently chooses the second. So why does Warren Buffett love boring businesses? Because boring businesses are predictable, protected by moats, compounding machines, often undervalued, stable in all economic conditions, cash generating, easy to understand. They may not make headlines, but they make fortunes. If you found this helpful, hit that like button, subscribe to Money Mastery Insights, and drop a comment. What boring business do you think is a great long-term investment? Thanks for watching, and remember, sometimes boring is brilliant.